Welcome back to Your Average Investor. Today we're going to be talking about the VWAP, or the volume weighted average price. We're going to go over what it is, how to set it up, and different straight trading strategies you can use with the volume weighted average price. Now, if you're totally new to VWAP, what it stands for, of course, is volume weighted average price. But what that means is if you take all of the prices that a stock was traded at over a certain number of time and the total number of shares purchased and sold, and divide those by each other, you get the VWAP. So for example, if I had a stock that, if I was going to do the VWAP for several shares, one that sold at $10, another at 11, another at 10, then 11 again, then 10, then 11, then 10, then 11. Right, so the price for this, if I were to take this, we have 1, 2, 3, 4, 5, 6, 7, 8 purchases or sales at $10 and $11, added all together and then divided up gives us the VWAP. So what I would do is I'd say 10 plus 11 plus 10 plus 11 plus 10 plus 11 plus 10 plus 11, right? And I get 83. I think I should have 84 there, actually. 1, 2, 3, 4. Did I miss one? I think it's supposed to be 84. It's supposed to be 84. Anyway, 84. And then I would divide it by the number of purchases or sales. So 1, 2, 3, 4, 5, 6, 7, 8. Divide that by 8. And that gives me a volume weighted average price of 10.5. Now, the reason this is important is because the volume weighted average price is typically where institutional traders will put buy and sell orders at, right? So if you or I were to go buy GameStop today because we're like, hey, I want to buy the dip from this crazy rally and take advantage of it, we would just buy. You could buy 100 shares, you could buy 1,000 shares, you could probably buy 10,000 shares, and it wouldn't really affect the price of the stock. Maybe at 100,000 you might get like a little blip up or something. But if you wanted to buy, say, $100 million of GameStop, or $1 billion of a company because you're a big institutional trader and you want to swing that power around, or maybe you're rebalancing your portfolio of clients and you have $10 billion of assets under management. Well, in that case, if you were just to put in a single buy or sell order to fill immediately, it would massively spike or massively drop the price of the underlying asset, and you would not get a good fill. So instead, what they do is they say, I want to sell on the volume weighted average price of the day or of the week or of the month or whatever they're looking at, or until filled, or I want to buy on the volume weighted average price. And because of that, the volume weighted average price can act as an interesting indicator for both scalping and for swing trading. So we're going to look at swing trading first, and then we'll move into the scalping strategies. Now, if you want to know how to set these up, you set it up just like any strategy. You click the strategy button, and then you find your strategy and add it. I will put these strategies, because I think some of these are custom strategies that I built. I don't remember which ones are custom and which ones are innately within Thinkorswim. So I'm going to share these so that you can use them in your own trading if you'd like, and you can set them up on your trading platform. I'll just put the link in the description. And speaking of which, if you haven't already, please subscribe to the channel. It does a lot to help support us as we're working to monetize this channel so we can put out better and better content for y'all. Now, let's look at the volume weighted average price on the long term. And what I've done here is I've created an indicator that takes recent highs and recent lows, and it sets up a volume weighted average price based on that start point. So in this case, we're looking at GameStop, and actually we're going to look at it after the big meme rally 2021. So this was the 2021 rally, and we're going to look at GameStop right after that, right? So here's a volume weighted average anchored to the low right here on 219, and then the price pops up off of that. And if you're tracking this volume weighted average, what you would notice is all of a sudden the price moves right back down, and it crosses below a little bit. But let's say you enter here when it just, when it crosses below at like $32. A couple days later, boom, boom, we're back up at $55 before having another little bit of a sell-off, comes right back down again. You can see the touch there is a lot more precise at about $33.50 before a nice little rally. And then it comes down again and touches. And at this point, the indicator is going to create a new volume weighted average anchored to this day. But you can see if you entered there, nice move up. And then look at this. It's not a perfect indicator. Just like every indicator, they're not perfect. At this point, the price moves down, and maybe you get a couple literally 2-3 day trades, right? You buy here, you sell here, you buy here, you sell here, but you don't really get any good movement up off of it again. Instead, it finally cuts beneath the volume weighted average, and that trend is broken. So this is really good for uptrends. But on the other side, you see this, right? This volume weighted average, this red line here, is anchored to the high right there. And so maybe we can use that as an indicator if there's a downtrend to go short. And look at this. We come up here, boom, it comes up. And if you were to short GameStop there and incur the wrath of the entire retail trading community, well, you'd make some pretty good money. You'd move from about 57 down to a low here of 45. But at the same time, again, notice here we've got another volume weighted average that's established, moved up, and it's bouncing up off of this, and it's creating a little bit of a squeeze. So you've got strategy one is to swing on the upside of these lower ones, right? The anchored volume weighted average here, you swing there, or on the upside you swing as a short, either buying puts or just shorting the stock. And you short here, you'd short there, but then sometimes you get something like this where it starts creating a squeeze and the price will bounce between those, and then it has to break out one way or the other eventually. In this case, as the squeeze is happening, it breaks to the downside, and then eventually we have a nice little upside movement again. And look at this, we're starting to get another little squeeze, breaks to the downside again before moving down and down, much further on until more recently. But let's look at recently. Speaking of, like, let's just say you wanted to get in on GameStop now. Check this out. And again, this is not investment advice. Do not take this as advice. Do your own research. I'm not responsible for any trades that you make. But this is just how I use this as an indicator. I may be using it to buy some GameStop soon. I don't know. I'll see when that happens, if there's anything else that lines up for or against it. But we've got a volume weighted average anchored here to 416. And you can see now after this recent rally, the price is coming right back down. Hasn't quite reached there yet, but maybe in another day or two, the price comes down and touches this 26, 25 range. This is also the range that I like because if you look at this day here, the day of the first pop, that's the lowest that the price touched. So we have a little bit of a convergence there, right? I would think that would be a decent place to go long and start building a position. Of course, with a tight stop loss and all of your appropriate risk factors, that's ultimately going to determine what makes you successful long term, is if you have appropriate position sizing and risk management so that when the trades do go against you, you lose small, and when they go for you, you win big. That's a way to swing. Let's look at a different stock, though. Let's just look at the S&P 500, because this can work with a number of different stocks, right? So here's the S&P 500. Let's look at the post-COVID dip rally. So if you were to anchor a volume-weighted average here, and then look at this, it comes up and it bounces down and almost touches before accelerating again, and does that a few times where it never actually touches. This rally was so intense that it never really touched back down here. But then you establish a new anchor here, and then it cuts below a little bit, but say you went long there, moves right back up. And you can actually set your own anchors too. I'll show you how to do that. We're going to set an anchored VWAP, and right here I've got a date applied to it. So if I hit apply, I don't know what date it's anchored to. There it is. It's anchored to like 1/1 of 2020 or something like that. But I can move that anchor forward. Let's say I wanted to anchor it right here to 1/29 of 2021. What I'm going to do is I'm going to open this up, and I'm just going to change this to 1/29 of 2021. I'm going to hit apply and OK. And there we go. There's the anchor, and you can see the nice band on either side here. But the purple anchor is the purple line is the VWAP. That's what I want to pay attention to. So I zoom in there, moves up off of this, comes back down, kind of pitters around and cuts below, but then this next time it bounces right off of it before moving on up again. And if I would like to, I could also move this anchor up, right? So it bounced here, so maybe I move the anchor up now to 325, and watch what happens when I do this. I'm going to move that to 325. And look at how it catches these next few bounces very nicely, right? 1, 2, 3 bounces, super nice catches there. So you could manually set your own anchored volume-weighted average and then use that as an indicator for swing trading and say, you know what, I really like playing when it comes back. If we're in an uptrend, playing when it comes back down, or if we're in a downtrend when it reaches back up, buy puts or something like that. And you can see these upper bands, they sometimes, and lower bands too, if we're in a downtrend, they'll catch when it looks like the price is getting a little bit too far away from the volume weighted average, and so that might be an indicator that it's time to close the position or maybe set a trailing stop. And then look at this beautiful bounce down right onto the volume weighted average before exploding back up. Beautiful move from 430 to 470, 40-point move on SPY. And then eventually, right, let's look here. I'm going to take this one off now. We're going to take the anchored VWAP off and just use the auto anchors again. Eventually, the S&P 500 entered this downtrend for about a year or year and a half or so, right? And during this time period, same thing. These green lines, they don't really mean anything anymore. The price just kind of cuts right through them. But take a look at the red lines, right? Volume weighted here moves down, pops right back up, and bounces right off of that 1, 2, 3 times beautifully. Cuts above it this time, so we start a new one here. Bounces 1, 2, and continues to move down. Never really touches that again, but maybe if we were to move the anchor to here, we would see it lines up with this little area here. And then eventually, right, here's another one, boom 1, boom 2. A little bit of a move down here, and then it starts cutting above again, and that's when we start seeing a move back into an uptrend. And now these red lines are pretty much completely invalidated, and the green lines are what are good positions to start buying in at. So it's a great way to go long or short depending on your thesis by using the volume weighted average anchored to recent highs or anchored to recent lows. This is a great example here, right? We've got an anchored high here, an anchored low there, and it's starting to create a little bit of a squeeze in between the two where both are being respected, right? 1, 2, 3 touches here, 1, 2, 3 touches here. Eventually the price looks like it's going to break down, but then it just moves back up, and we get this nice, incredible rally again before, like most recently, check this out. This rally here from, we'll call it 409 to 530, and the price just never even really gets close to touching back on this volume weighted average. For some people, this would be an indicator that a pullback is due. For other people, they just say, hey, don't fight the trend, ride the wave. But let's look at how it would look on a day trading perspective, right? If you wanted to do some scalping, we're gonna go back to GameStop now and look at some scalping. So what I've done now is I've got this new indicator, and what it does is it takes the volume weighted average price, but it sets it at the beginning of every trading day. So it will start at the beginning of the trading day. You can actually set it to beginning in pre-market hours or to begin at actual market open. Either way, it could be argued either way is just as good as the other. But what I like to look at this is there's two main strategies you can use here. One is revision towards the mean, and that's represented by something like this, right? I've got this band above and below. In this case for GameStop, I've set it at 10% above, 10% below. So if the price goes 10% below the volume weighted average or 10% above, that's what those lines are. And you can see here it cuts 10% below and then bounces up, cuts 10% below, bounces up again. So it's a little bit of a revision towards the mean or revision towards the volume weighted average. Not a perfect indicator, but it's interesting. The reason this isn't a perfect indicator is the volume weighted average isn't a static number throughout the day. And so in this case, you can see the volume weighted average started at 34.93. At the point that it crossed below, 10% below, is at about $33 was the volume weighted average. And right now the volume weighted average is at 31.6. So it's gone down about $1.50. So what that means is if this sell-off had been a little more intense here, the price had struggled down here even longer, perhaps this curve is a little steeper and the volume weighted average could be such that it's down here at like $29.50. And if that's the case, well, I bought here at $29.50 and the price did eventually revert to the volume weighted average, but it didn't revert in the sense that GameStop climbed up. It reverted in the sense that the amount of shares being bought and sold down here brought the volume weighted average down. So that's something to be aware of if you're playing revision towards the mean. The other option, of course, is to play the trend. So in this case, I can see the trend seems to be that as it gets close to the volume weighted average, it pushes down. And so maybe I see that happening here and I decide to go short. And in this case, it would be correct. And that could be another way to play it. Let's actually just rewind to yesterday. And you can see here, very interesting, because of how much volume was traded in the pre-market, by the time market opened, the price is already below what the volume weighted average has been set as with the pre-market trading. So in this case, you might want to actually set it to where the volume weighted average starts at the beginning of the trading day. The way to do that is just to open your settings, go to equities, and then click show extended hours trading session, turn that off. And when I turn that off, you'll notice that now the volume weighted average, oops, I'm on the wrong day, right here. The volume weighted average for the day, and it's going to get kind of tricky, so I'm going to see if I can zoom in exactly on this day. There we go. It starts right there with basically where the candle opens, right? So it's no longer hovering way far above it. Now the volume weighted average is right here. And you'll notice if I fast forward to the next day, it's changed a little bit on that too. So all I've done is I've changed the anchor. So the anchor now starts here at the trading open. And you can see, look at this, bounces down, finally cuts above and moves up. And so this is the other strategy, right? Is if I'm seeing there seems to be a trend where anytime the price comes up to the volume weighted average, it starts retreating. Maybe I use that as an opportunity to short the volume weighted average, or excuse me, short the stock. And if I see the opposite trend happening, maybe I go long when it's at the volume weighted average. Again, you can see here, this is a great example. It's not perfect because let's say you'd been paying attention to this trend, you saw that, you're like, oh, false breakout, it's coming down. I'm going to go short right here. You're instantly wrong, and the stock just climbs. And so that's why, again, set your stop losses, make sure you're trading with appropriate position sizes. And we'll move into the next day real quick so you can just see again. You can see the slight difference there, right? It's almost the same, but these lines are actually a little bit more accurate now, these 10% lines. I'm going to go ahead and turn this back on, the extended hours, because I actually like it. I think it's a little more accurate with extended hours because generally you don't have stuff like this where there's so much volume in the pre-market that it drastically affects the volume weighted average. And if you do have that kind of volume, then it's probably important to pay attention to. So look at this. Let's just say you were playing the pre-market trading, right? And you saw all this happen and you're like, oh my gosh, I missed this run up to $80. And then you saw it bounce down and come up and then bounce down again. You go long here at $60. You could have played that up to $70. And you know, if you didn't take profits, you'd be at a loss now, but you can use that as a potential indicator again. And let's rewind even further, just one last example right before the massive surge, right? So here's a great example of both revision to the mean, and this is a great example of also not playing the first 30 or 45 minutes, maybe even hour of the day. There hasn't been enough data to establish a good baseline for the volume weighted average usually. And so if you're using this to scalp, I would personally not use it within the first hour of the trading day. Some people like to use it as a way to say, hey, you know, just like they just automatically reverse. So if the price breaks above, they'll always buy puts. If the price breaks below, they'll always buy calls, assuming that it will move back like this. But again, you can see, like, say that you bought puts right here. Yeah, like eventually the price did come back down, but it didn't come back down far enough or fast enough to where it actually makes you profitable. So that's why I would ignore this. Wait till you get a nice trend line or baseline of enough volume where it actually has a true average. And then you can see what's happening here, right? So it's kind of just oscillating in both directions, not really moving up, not really moving down. So you might say, all right, anytime it gets a little too far below, if I'm overall bullish GameStop, then I'm going to say I'm going to start accumulating down here, and I'm going to start selling up here, right? This might be my first indication of that. So I see it happen once, I see it happen twice. So right here I'm going to start accumulating shares, and then I'm going to sell into this strength here, and maybe I start accumulating shares here again and either sell there or maybe set a trailing stop or something like that. And then towards the end of the day, I could see this and go, oh man, that's actually a big sell signal. Say I'd been accumulating here and I didn't get knocked out by my trailing stop and I'm up here. I'd go, maybe that's a good chance to sell because we're 10% above the volume weighted average. Sure enough, hindsight's 20/20, but sure enough, the price moves back down to this area. So really interesting way to play it if you're looking to scalp. Let me show you what it looks like on something like the S&P 500. And of course, I'm going to have to change these bands a little bit. This is 10% is much too far for the S&P 500. So let me go here, and I'm going to change this to be 1% about. I found usually, 99. Usually 1% is pretty good for the S&P 500 as a way to show like, hey, let's get revision towards the mean. And even you could even go tighter than that if you're playing, but like 1% is generally a pretty safe place to do it. So let me zoom out, and we're going to see if we can find any point. Oh, that looked interesting. There we go. Look at that. All right. So overall, pretty dull day on the S&P 500. Doesn't do anything. Something must have happened with the news, and all of a sudden, price skyrockets. And then look at that. Massive sell-off, basically back to where you started, right? If you follow this, this comes back right to where you started again. But this is interesting. The price skyrockets. It's now trading 1% above the volume-weighted average. And this is a pretty dang accurate volume-weighted average because it's had the entire day to trade at that VWAP. So now it's it's pulling the volume weighted average up, but it's still 1% above it. So let's say you go short here, and typically the way people will play this on SPY is with 0 day to expiration options. Because if you were to short SPY right here in shares, you're going to make 1% on this move, right? Let's say you like nailed the tippity top at 508 and it got down here to 501 and then like you literally nailed the bottom at like 500. So you'd make like 1.5% on that move. And I mean, you got to ask yourself, is that really worth it to short the S&P 500 for a 1.5% gain? Maybe. But let's look at what happens when you use 0 day to expiration options. And to show this, I'm actually going to put the option symbol of that day right here. So the put 507s. So let's zoom in here. Put 507 because that's about where it crosses above here. So, you know, if I wanted to enter right here, I'd probably buy the put 507s. And then look what happens here. Now, again, a disclaimer. This is not financial advice. This is not trading advice for you specifically. You need to do your own research, your own due diligence. You need to do your own risk management and decide what's best for you. I'm going to show you some risks associated with this, right? 0 day to expiration. This is the day that these expired. You can see, let's just say I bought right here. I would be paying about $180 for these contracts. Within about an hour, they're now trading at $60. I've lost 66% in an hour because the price just kind of stayed flat, right? The price didn't even really go up and I bought puts, but the price is flat and this thing expires in a couple hours. So that's why 0 day to expiration options are so tricky, is because you can bleed out value incredibly quick on those options. But on the other side, you can also gain a lot. Remember, you can only lose 100% unless you're doing something stupid and like selling naked options or something like that. Then you can lose a lot of money, like way more than you expect. But if you're just buying a put, you can only lose exactly how much money the put cost, and that's it, right? So if I bought a put for $180, that's my max loss. On the flip side, I could make 200%, I could make 300%, whatever it is. In this case, if I bought here at 180 and I sold here around 600 at end of day, I would end up making over 200% profit on that position. Now, if I timed it a little better, or maybe I averaged my way in, I bought half a position here, I bought a little bit more here, a little bit more here, and so my average is down to something like 100, maybe 110. Well, in that case, now I've just 5 or 6, or if I nailed the low exactly, I 10x'd my money over the course of this last hour of the trading day. So it's a really interesting way to look at playing this, is playing something that is highly correlative to the VWAP, such as SPY or QQQ, and then playing a revision towards the mean. And of course, you can play the other way too, where you're saying, I don't want to play revision towards the mean. Instead, I'd rather play where I just identify the trend and I go with the trend for the day. And you can try to do that too, right? So you can say like, okay, look at this, it cuts below, came above. You know, we don't really have a trend establishing here, so maybe that wouldn't be a good day for it. But some days, there's a pretty clear VWAP trend, right? So here we go, we're above it, bounces off of it, bounces again. So at this point, right, I'm going to buy, either go long shares or go long calls and just ride it through the rest of the day. In this case, if this were me, I would not, if I was playing the little bounces like this, I would not necessarily buy the 0 day to expiration contracts, because it could take several hours, like in this case, right? It takes about 3 hours to get from 507 to 509, so about $2 in price appreciation. And let's just modify this contract down here to represent this day. So this is 426. We're going to buy a call 407. So we're going to switch this to call, 507, and we're going to change this to 2404. And what was it, 26 did I say? Yeah, 0426. Okay, so here we are right here, right? So these are the 0 day to expiration contracts, and it's, you know, it's not bad, right? I buy at 180, and as the price continues to move up, now I'm at 240, and now up here I'm at like 280. So I've gained a nice 60 to 80% depending on when I sell. But then of course, if I don't sell here and I wait till the end of the day, even though the price is technically above the price that I bought at, in terms of the SPY, the price of SPY, right? The price of the contract has fallen way down because of that time decay. This expires literally right now, and it's barely above where the strike price is. So I hope this video was useful to you guys. Again, if you haven't, please subscribe. It helps support the channel so we can monetize this thing and get better and better content for you guys. I'd love to hear other ways that you'd like to trade the VWAP. If you have any fun strategies, drop them in the comments. If you're interested in using these indicators, I'll put them in the description so that you can put them into your own Think or Swim. Have a great day, everybody. Catch you next time.